Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, March 27th, 2026. We're recording at 5 p.m. Eastern Daylight Time. I am your host, Scott Slayton, partner and chief strategist at Capital Creek Partners. So your starting lineup, number 1, an Iranian war update, stranded in the Strait of Hormuz. Number 2, the 3 bullets to the brain for risk assets. And number 3, the commodity supercycle, a successful handoff from precious metals to energies. So back to Iran. We started the week with markets hopeful for a deal to end the war as the president was trying to talk into reality a deal that could end this conflict. And both sides released their demands to end the conflict. The U.S. a 15-point plan and the Iranians a 5-point plan, yet it all boils down to Hormuz. The U.S. demands that Hormuz is opened and returned to normal traffic, and the Iranians demand that they have control over Hormuz in the future. Strategically, if Hormuz remains closed, Iran wins the war. However, if the U.S. and its allies can pry open Hormuz and keep it open, the U.S. and Israel win the war. So we put forth what we've called an Occam's razor theory of the war, the simplest answer being the most likely. That if Hormuz remains closed, oil prices continue to ratchet up. And if oil prices go up, government bond yields go up. And if U.S. government bond yields go up, the dollar goes up. And with those two things, yields up, dollar up, equities go down. And the economy begins to weaken and inflation goes up. So despite the pummeling, Iran won this week, in our opinion, because the Brent crude oil market closed at its highest level since 2022, since Russia launched the war on Ukraine. Brent closed over $114 a barrel today. We remain tactically bearish risk assets with a 6,000 target on the S&P 500, which we laid out on March 4th in a report entitled As Long as It Takes. So now we're 2/3 of the way to our original 6,000 point target on the S&P 500. So where do we go from here? Well, we're going to stick with that for now, but we think we're going to get there pretty quickly. The VIX is now at 31, which is getting closer to the kind of panic levels we think we need to see to be able to put in a decent bottom. But we expect to see 40 or higher on the VIX. And we do not believe we've seen broad capitulation yet. Yes, we've seen capitulation in software. Yes, we've seen capitulation in BDCs and also capitulation in alternative asset managers, but no broad capitulation yet. On to number 2, the bullets to the brain. Fed tightening, recession, and geopolitical shocks are the 3 bullets to the brain for risk assets. So with respect to number 1, Fed tightening, it's unlikely, in our opinion, that we will see a tightening this year. Yes, inflation is going to go up, but we think this Fed is going to be more and more concerned about growth and employment as the year grinds on, and they will not hike. But we must admit that all cuts have been priced out of this market now for the entire year, and there is now a 28% probability of 125 basis point hike by the October meeting. So the market has done a complete about face where it was pricing in 2 to 3 cuts to start the year. It's now priced out all those cuts and is actually pricing in the potential for a hike in the fall. Now, thinking about recession. When we wrote our investment outlook early in the year, in January of this year, we had the odds of around 10% that the US economy could have a recession. So very low odds of recession. But today, in the face of the war, those odds have now increased to around 1 in 3. And if oil prices go into the $150 to $200 a barrel range even for weeks, then we think the odds of recession go up sharply. Now, a geopolitical shock. Well, that's already happened. Obviously, the Iran war is a major shock to the global economy. And it's interesting to see how all of these bullets are really linked together in the war. Let's remember that the US economy is a resilient beast. We saw that last year when most of us thought tariffs were going to knock the economy into recession. Not even close. It did not happen. The U.S. consumer is the 8th wonder of the world. We don't ever want to bet against the U.S. consumer. And that consumer, based on what we're hearing, continues to hang in there pretty well. And let's remember there was a lot of momentum in the economy going into the war. We had the One Big Beautiful Bill legislation that cut taxes. We're seeing regulations rolled back, deregulation. We're seeing expensing of capital investment decisions. We know we had a huge AI-driven CapEx boom going on, and a lot of that is still a tailwind to the economy. We know the war is a big headwind. And I would put forth that if U.S. troops are deployed into the Iranian war theater, that could be the straw that ultimately breaks the back of the U.S. economy, because I think it would really be a major escalation of the war. I think the U.S. consumer could pull back. I think markets would take a troop deployment very poorly, and I think it would drive down risk assets even more and increase the odds of a recession. So that is the one thing that I am watching that I am most concerned about, would be troops being deployed. I think a major negative from here, and could trigger these 3 bullets to all go off. Now, number 3, the commodity supercycle. A commodity bull market was born in the COVID pandemic back in 2020. The supercycle was born of years of underinvestment and low prices post the great financial crisis. And remember ESG. ESG had made investing in commodity companies, in mining projects, in oil extraction, all of these things had become politically unacceptable to institutional investors. And many of them did not want to invest in commodities at all. This led commodities to become very cheap relative to financial assets. And precious metals led the first leg of this great bull market from 2000 through 2025. Earlier this year, we could see energies taking the baton from precious metals, and that's really accelerated since the Iran war broke out. And we think energy commodities have further to run. We don't think this game is over yet. Agricultural and soft commodities may be the next leg to run as energy inflation feeds through the entire food system. Think about what it takes to grow food. It takes diesel. It takes fertilizer. It takes chemicals. And there's a lot of energy embedded in our food, in our agriculture, in our soft commodities. Well, unfortunately, very few individuals or institutions have broad commodity exposure. And that's a shame, because commodities are the only asset class prospering in 2026. And believe me, they are up a lot, well over 20%. when other assets are now clearly in the red for the year. So commodities add diversification and portfolio ballast in times like today. And they also provide inflation protection, and that is coming through during this war. So we continue to think the commodity asset class is an important, valuable asset class for portfolios. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.